All right, distribution. So we saw in that box that $26,000 distribution that was recorded for this particular partner. Partner will usually recognize no gain or loss on any non-liquidating distribution. What's a non-liquidating distribution? So that means that they still have the same ownership. The distribution did not change their ownership. It's just amounts that they're getting out that it was there. Think of the partnership as it's like a bank account, right? When you deposit money into a bank account, you don't record any gain or loss on it. You're just moving your money from one place to another. When you withdraw money from a bank account, you don't pay tax on it. It was your money. You're just moving it from one place to another. Sort of the same thing with a partnership. When you invest in that partnership, you're just moving that money from one place into another. And then when you take it out, as long as you had money in there and you're not overdrawn, you don't pay anything on that. It's just your money that you're getting out, right? So that's what a distribution is. It's just essentially extracting some of that ownership that you have in that partnership, moving it from one pocket into another pocket. And usually, as long as you're not overdrawn, you do not pay any tax on them, okay? So here we've got example, Davis is a 50% partner in ABCD partnership. He has a basis of $85,000 in his partnership interest. He receives a cash distribution of $84,000. Gets $84,000 in cash, he doesn't have to pay any tax on that. Again, he's just making a withdrawal from his account. He recognizes no gain or loss, but his basis is reduced to $1,000. Just like if you were to take that money out of your bank account, you would now have a balance of $1,000, right? So that distribution is essentially, and it's again the same concept as a bank account. You've already paid tax on that money. It's not income. It was income before. You just put it into the bank. So you don't have to pay tax on it again then when you take it out. It has already been taxed. And that's the concept behind all of those basis calculations is we've got to figure out, okay, how much have we already paid tax on? Because we don't want to pay tax on that again. But if we take it out and we haven't paid tax on it, you can bet the IRS wants you to pay tax on it at that point. All right? So there are two exceptions to any gain. So when money or marketable securities are distributed in excess of the partner's basis, then you have to recognize a gain to the extent of the excess. That means you're overdrawn in your bank account. You had $84,000 and you took out $85,000. You're now overdrawn by $1,000. You're gonna have to pay tax on that $1,000 at that point. Or if the current distribution triggers a pre-contribution gain, I have to go through that again because I always forget what that is. But that basis can never go below zero. So let's see. And if they recognize the excess, then it's a capital gain. Okay, so it's not like ordinary income, it's a capital gain. So here, same example as before, but his distribution was $86,000. Then he's got to recognize $1,000 of capital gain, so it's going to be taxed. Because it was taxed, then it's going to bring that balance back up to zero. Okay, but he's got zero basis in that partnership. If he has income next year in the partnership, that means that income, that ordinary income, is going to be taxed. So therefore, we can add that to the pile of money or funds that have already been taxed. And we're not going to get taxed on it again when we take it out, when we make that withdrawal. Here we've got Bailey. What is this? Oh, the pre-contribution gain. I never experienced this when I was practicing, so that's why I always have to kind of remind myself. When a partner contributes appreciated property to a partnership, so it's gone up in value. So I have some land, I contributed it to the partnership, it was $10,000, and then it's gone up in value to $50,000. But when I contribute it, it's $50,000. So it's appreciated. I bought it for 10,000, it's now 50,000, I'm gonna contribute it to the partnership. Guess what? If I were to sell that for $50,000, I'd have a gain that I have to recognize of $40,000, right? At that point, I would. So, when you contribute appreciated property to a partnership and within 7 years, the partnership then distributes the same property to another partner. Because what you've just done essentially is avoided any gain on that transfer. So I've got land that I bought for $10,000. I'm in a partnership with my brother. I want to transfer that land over to my brother. I'm going to transfer it to him indirectly by going through my partnership. Now I'm contributing land with a fair market value of $50,000, thus avoiding any gain, and he's getting land, a distribution then of $50,000, and then nobody pays any tax on it. This is to avoid that sort of circumventing that. So if you sell it then within 7 years, the partnership distributes the same property to another partner. In essence, the contributing partner is selling the property to the distributing partner and attempting to eliminate the gain by passing it through the partnership. If the contributed property is distributed to another partner within the 7-year time frame, then the contributing partner would recognize the deferred gain. So then you'd have to recognize that $40,000. So this is just, a way to try and prevent. If people just behaved to themselves, we wouldn't have to be so complicated with these rules. But all the rules are all set up for people who don't follow them, right? And the rest of us have to suffer as a result. Okay.
So what if they waited that 7-year time frame?
Yeah, after the 7 years.
Mm-hmm. Could they still do it?
Mm-hmm. Then they could do it.
And
there would be no gain, right?
Even if the fair market value went up?
Mm-hmm.
Okay.
Yeah. The idea is just, they don't want to, I don't know why 7 years. I don't know why that's, but you've got to be able to distribute it at some point.
Right.
Right? You can't wait forever to distribute it. So anyway, I don't know why the 7 years. So here we've got Bailey contributes land to a partnership with a basis of $8,000 and a fair market value of $12,000 in 2021. In 2022, when the fair market value of the land is $14,000, the partnership distributes the land to Jessica, another partner. The distribution triggers a pre-contribution gain of $4,000 to Bailey. Jessica has no gain or loss and would have a basis of $12,000 in that case, because that $4,000, the tax is being paid on that $4,000. It's not being paid by Jessica, it's being paid by Bailey. So it's appreciated, had a basis of $8,000. It was appreciated, she contributed it. Fair market value went up to $14,000. So the gain on that is the difference between what her basis was and what the fair market value was on the date that she contributed it. When property is distributed to a partner, neither the partner nor the partnership will recognize any gain as long as there's basis, right? As long as that partner has basis. The basis and the holding period of the distributed property carry over to the partner. So just like when you contribute property, everything carries over. Same thing happens when you distribute. Partner steps into the shoes of the partnership. The only exception occurs when the basis in the distributed property exceeds the basis in the partnership interest. So again, we're withdrawing more than we have in our bank account. We're overdrawn. The basis of the distributed property is limited to the basis of the partnership interest. Partner would recognize a gain only if the distribution exceeds the basis. So Fonda has a partnership basis of $6,000. She receives from the partnership a distribution of equipment with a basis to the partnership of $8,000 and a fair market value of $5,000. So the basis in the equipment to Fonda after the distribution is limited to her basis in the partnership of $6,000. So she can't, the most would be $6,000 that she can recognize for the basis. She recognizes no gain or loss. She has a 0 basis in her partnership interest after the distribution. So essentially, because she's getting like that, even though she is stepping into the shoes of the partnership, she can only, and the partnership had a basis of 8,000. Ordinarily, if the fair market value was higher than the basis, then she would be limited to the basis. But because in this case it's lower, the most that she can get as far as her basis is what her basis was in the partnership. You getting tired of hearing me say the word basis? Same facts, Fonda receives a $2,000 cash distribution and the equipment. So in this case, she's gonna first reduce her partnership basis by the $2,000 cash distribution, that comes first. She still does not recognize any gain, but now she has a basis of $4,000 in the equipment. So she got 2,000, let's see, 2,000, and so that's minus the 4,000. So the basis from the partnership just transfers over to the equipment in this case. I have to think about this for a second. Because this can kind of, so, partner steps in. Basis of distributed property is limited to the basis of the partnership interest. Okay, let's look at these, try and work through these to see if this helps us to figure this out. So Nelson has a partnership basis of 12,000. He receives from the partnership a distribution of furniture with a basis to the partnership of 16,000 and a fair market value of $10,000. So his basis in the furniture, so now we're talking about the basis in the furniture, not the basis in the partnership. So it's gonna be limited to what his, so it says up here, where is it? So when the basis of the distributed property exceeds the basis in the partnership, the basis of the distributed property is limited to the basis of the partnership. So in this case, his basis in the partnership is 12,000. Basis of the furniture is 16,000 to them, but his basis is gonna be limited to his basis in the furniture, which is $12,000. Somebody can check me on that. Make sure I'm right. All right, in this case, he receives a cash distribution of 4,000 with the furniture. So again, the furniture has a basis of 16,000. So the $4,000 is gonna reduce his basis to $8,000. And then the furniture, then he's gonna have a gain of the difference between, so this was 4, so now it's gonna be 12, let me think about this for a second. So he receives a distribution of 4,000 with the furniture. Think through this. They don't really talk about it with the cash here, do they? So in this case, so Fonda received a $2,000 cash distribution and equipment. She's gonna first reduce her partnership basis by 2,000, so we're gonna do the same thing here. So his partnership basis is 12,000, and we're gonna reduce that by the $4,000 of cash, right? $8,000 basis remaining. And then he received furniture with a basis of 16,000. So his, let's see, he's gonna have, I think, the basis of the furniture to him. So what happens is the additional amount, the difference between those two, attaches to the basis of the furniture for him. So is A correct? I know you're all like, what? I think there might be some kind of problem with this. We'll look.
Is there any answers in the book?
It's at the back of the book. It's in the, so there's like answers to the, and this one is concept check 14-5. So is this one A?
Mm.
Mm-hmm.
3 is a 8,000.
Mm-hmm. 8,000?
Mm-hmm.
Okay. So, first thing you do is subtract the cash. That reduces his, that then adjusts his basis down to $8,000. So his original basis was 12,000, right? 12,000 in the partnership. He got $4,000 cash out. Take that out off the top. His remaining basis is $8,000, but then he also received furniture with a basis of $16,000. That's more than what his basis is, right? His basis right now is $8,000. This furniture has a basis of $16,000. So we're gonna take $8,000 of this $16,000 is gonna reduce his basis further down to 0 in the partnership. Okay, so we've got a partnership basis and we've got furniture basis. So this is the partnership basis. Gonna take that out of the 16. We're left with 8, right? So this is the furniture. 8,000 of that, we're gonna take the partnership basis down to 0. We've got another $8,000 of basis that's being taken. Now, ordinarily, if that were cash, he'd have to pay tax on that, right? Because it's taking his basis down below 0. So he would have a gain of $8,000. But it's not cash. So instead of paying tax on it now, what happens is we're gonna reduce the basis of that furniture by the amount. Eventually, he'll pay tax on it if he has a gain, like say he sells the furniture for $20,000. Now his basis is 8,000 rather than 16,000. Okay? I'll see if there's another problem in the homework. Questions? All right. Let's get on to the last.